Welcome to the show. It gives me great pleasure, as always, to introduce Mr. Tim Gregory, Chief Investment Manager at Vermeer Investment Management. Morning to you, Tim.
Morning, Nick.
Right, we're going to talk some specifics about your funds this morning. Reading the headlines, founded in 2016, and you're the founder and CIO. Is that a stressful job?
Well, look, I've been a fund manager for 30 years, and I absolutely love it. So, yes, it's stressful. You know, there's nothing worse than turning up for work in the morning and discovering that one of your stocks has had a profit warning. And, you know, I think when we launched in December 2016, we were right in the middle of the Trump trade, and a lot of stocks that we liked had done unbelievably well. And you had to take a lot of deep breaths to actually decide to still invest in them at that point, having been good. And actually what it led to was the fact that we made a decision that rather than invest in a portfolio that was excessively concentrated to the minimum number of our stocks, i.e. 30, we actually decided to go with a more balanced approach. And so we've actually been running pretty much the whole year since launch with more like the 60 stocks maximum that we have, deliberately to have a more balance, because we just felt that some of the trades that had been so hot, some of the banking stocks that had been hot, some of the infrastructure trades had been so hot that we thought it was a good opportunity. Just be careful about that. We've deliberately run the money as if the fund were a lot bigger,
right,
as if it were a billion-ish, or a few hundred million, or whatever it might be, because I think to demonstrate credibility in the long run, have to say, oh well, they just have used the fact that it's a very small fund to just take advantage of market anomalies and things like that to enhance performance. But we haven't done that. We've absolutely stuck to what we see as our long-term strategy to invest in high-quality growth companies.
Okay, let's go into some detail now. We've got a number of slides you kindly sent. Let's kick off the portfolio market cap split and the market cap position size. A few words on both of those, please.
So this really just demonstrates the fact that we are an all-cap fund. And as I said earlier, we do own Microsoft, and we do own Facebook, and we do own Apple. So, three of the biggest companies in the world, three of the stocks that done particularly well already, but we still think are good value. But we also own a number of mid-cap stocks, mid-cap by a more global definition. So mid-cap stocks that would probably be FTSE 100 companies. So to give you an example of that, we own a water solutions company quoted in the US called Xylem, which is about a $12 billion market cap. And what Xylem does, it provides water solutions right around the world. And water, as you know, is one of the most prized entities, and one of the things that is most capable of putting certain industries at risk. You've got to have clean water, and China and India are investing very heavily to make sure that their water is cleaner going forward. And this is true all over the world. So that is a $12 billion company. It's one of the core positions in our portfolio. It would be a FTSE 100 company in the UK, but by the definition of more global as 12 billion, it would be in the mid-cap category, in that $10 to $50 billion sector. Understood. There.
Well, let's move on then to your top holdings. What's the maximum exposure you'd have in one stock?
So, you can see there Microsoft is 4.3% of the portfolio. Actually, since that slide, because that's to a month-end period, we've actually slightly increased that.
Right.
So that's more like 5. And, we might go up to 6, but that's really the maximum. And we tend not to go below 1%.
Right. So between 1 and 6. And in terms of that market cap, if somebody came to you with a great story in what I would consider a proper small cap, let's say an AIM market position, would you take that on?
Yes, absolutely. So we own a UK specialist flavours and ingredients business called Treat.
Right.
Which we regard as a very long-term, high-quality, well-managed, strong cash flow business that has been 2% of our portfolio at times. And so, we're very happy to have a position like that. But it would not tend to be initiated at a bigger size than that within the portfolio.
Right.
So we would tend to initiate stocks of that size at a maximum of 2%.
Okay. And the average time you have these stocks in portfolio?
Well, that's a really interesting question.
Obviously, it's a new fund.
Indeed. So we're long-term investors. What does that mean? That covers all sorts of definitions, as you well know, Nick. And the reality is, when you make an investment, over time, if you'd invested in Microsoft many, many years ago, that's been a great long-term investment, but there have been long periods of time where it actually hasn't performed that well.
Yeah.
But in a perfect scenario, you want to invest in these companies, and if they continue to perform and deliver and the valuation is still relatively attractive, we're going to stick with those until something changes fundamentally within the business or the valuation gets too high. On the flip side of that, although we always set out to invest for the long term, if something goes wrong and there is a change to the fundamental structure of the business, and disruption has been such a big theme of seeing industries that you think have got very good fundamentals, that suddenly everything changes because Amazon decides to enter into the market, we have to react very quickly to that. So we set out to invest for the long term, but if something changes, it's absolutely critical,
that you cut.
in my experience, that we cut bad positions. So generally speaking, if something has a profit warning, more often than not, we will cut it. So if something goes wrong, our general response is to cut it. We review it, and in certain cases we say, well, actually, I think the market's overreacted to that, and the fundamentals are still in place, and we think this is just a one-quarter blip because some orders have slipped into the next quarter, whatever it might be. We would run a situation like that, and we always review it. But generally speaking, sell disciplines are absolutely at the heart of good long-term performance.
Well, it's an old market saying, isn't it? The first cut's the cheapest.
Absolutely.
Right, let's move on to sectors. This always fascinates me.
Mm-hmm.
How, why, when?
Well, as you can see, we have a fairly broad array, and industrials and technology, you can see obviously we have quite a high percentage in those two. And a lot of that is capturing one of our big themes, which has been to invest in factory automation. So it's been a very long, poor CapEx cycle.
Yep.
Through the recovery that we've seen since 2009, capital expenditure has been under pressure. But what we're seeing now is a pick up in CapEx, but that CapEx is being led by innovative factory automation opportunities. So Keyence, Fanuc, Jungheinrich, IPG Photonics, all companies that sort of play to that theme. So right. Some of those are in industrial, some of those are in technology. So there's a balance there. And the other area where we've got quite a big exposure is in basic materials, and that's very diverse because Treat, the ingredients company we mentioned, sits in the chemical sector, so it's regarded as basic materials. But we also own stocks like Rio Tinto and BHP Billiton, where although we're not enormously bullish about the iron ore price, we think that these businesses have really been transformed by management that's under enormous pressure to maintain capital discipline, generate lots of cash, which, because they have very low cost production of the basic materials they get out of the ground, that they are able to generate huge cash, spend CapEx as necessary, increase dividends, maybe buy back shares as well.
Okay, let's talk about the country breakdown. United States, obviously, pretty important to you. Japan, a few words on Japan. We've talked off air, you like Japan. Are you still a buyer?
Indeed. So, obviously, just, I guess the point to make about the US, yes, it's our biggest geographical area, but, the overall exposure to the US it would be less than average for most people, right. I believe.
So you're actually underweight the US?
Indeed, we're underweight the US overall. And that's not because we're bearish of the US, but obviously to be overweight Japan as strongly as we are, we have to get that from other areas. And, we've been bulls of Japan throughout the period. We've got around 16% of the portfolio in that, and if anything, have been adding to that. And what we think is that although Japan has started to perform a bit better, that it's been in a very, very long bear market, that investors have shunned Japanese equities, not believing that the government would be successful with their economic policies, and not really believing the corporate governance story. So what we see in Japan is cheaper valuations than their US counterparts, some fantastic technological companies with very, very good balance sheets, very strong cash flow, starting to return those excess cash flows to investors. Now, actually, Keyence is a slight exception to the rule there. They have enormous cash balance. They make enormous gross and net margins, but their focus is on reinvesting the money that they generate into research and development to make sure they stay ahead in their industry. But a lot of other companies in Japan do have an opportunity to return a lot more money than they have been doing, and they are under pressure to do so by the stewardship code that's coming more and more into focus. So we think, although we acknowledge Japan as being good, we think it's only now that that's beginning to be recognised more widely by investors. And, remember, albeit that valuations were absurd in the late 1980s, the Nikkei was 39,000 and has had a great run.
But it's still half the price, right?
To 22,000. So, I mean, that is just optical. But, the simple fact of the matter is Japanese valuations relative to the rest of the market are still cheap. Having said that, for the market as a whole, we feel that 2017 has obviously been a very strong year. 2016, before we launched, was a strong year. And our basis for 2018 is that returns are going to be a lot lower. The multiple expansion we've seen in a lot of stocks and markets in general this year, we do not expect that to repeat next year.
Right.
Our thesis is that many of the growth companies that we've invested in, they will be able to maintain their ratings and they will still be able to grow in share price terms by the earnings growth and the cash generation that they generate going forward. And hopefully, that they'll have positive momentum and good upgrades.
Tim, we've run out of time. As always, thank you very much indeed.
Thanks very much, Nick.